Stock market trading. Level 1. Trading psychology. Trading psychology. Psychological training for traders. There are a few psychological resistance and support values commonly used by traders, such as for entry. A widely used technical point is 10% difference. A day trading system must include entry points or specific conditions that must be met prior to entering a trade. Or, for financial management, 30%. It involves the planning, controlling, organizing, and observing the financial assets properly to gain organizational goals and objectives. As a day trader, there are several psychological aspects which can affect the trades. Emotions can have a negative impact on your career as a trader. One must learn how to control one's emotions. Awareness is power. Become aware of all the biases attached to day trading. For example, sensory-derived bias, avoiding the vague, and tangibility of anticipation. Being aware of these biases can lead you to success or failure in the trading business. Learn control over stress, mindset, mastering your edge. A useful advice is always to visit the internet. The internet has a huge resource for helping you develop and understand all the psychological tools and abilities needed for conquering the trading world. Stages of development from amateur to professional. The first 5 skills that every trader from beginning to end need are analytical skill, research, focus, control, and record keeping. Mastery of these skills as part of your system will help you become a professional trader. Stage 1. Unconscious incompetence. Stage 2. Conscious incompetence. Stage 3. The eureka moment. Stage 4. Conscious competence. Stage 5. Unconscious competence. Market psychology. Market psychology is the overall sentiment or feeling that markets and their participants experience at any particular time. For example, price is a psychological event, a momentary balance of opinion between bulls and bears. Patterns of price action reflect the mass psychology of markets and market participants. Bulls looking for long trading opportunities associated with increased consumer confidence, increased anticipation of future capital gains, and bears looking for short trading opportunities associated with a general decline in the stock market, transition from wide investor optimism to investor fear and pessimism. Fear versus greed. The self is made up of 2 primary emotions that affect our mental and behavioral state. Fear is the emotion caused by the belief that something dangerous is likely to cause pain or a threat. There are 4 trading fears: fear of losing, fear of missing out, fear of letting a profit turn into a loss, fear of not being right. By controlling our emotions and having a good system in place, we can learn to overcome all of these fears. What is greed? The intense or selfish desire for something, especially wealth or power. In order to overcome greed, recognize it and try and stay within a system. Always stay with a 1 to 2 or less ratio. So what are the symptoms of fear and greed? Fear and greed indexes, like the one available on CNN, rate how fear and greed are moving the market. Arousal of consequences to reduce negativity and increase positivity. Hope, the idea of free. Irrational emotions. Override the rational decision-making side of your brain. Losses and how to deal with them. Common ways to lose. Missing trades usually happens when you are not focused. Do not take trades while being distracted. If you are tired and/or over-emotional, hesitating, especially after a loss, creating trades that have no logic, and ignoring trades that make sense. Overtrading. Never try to make up for losses, miss trades, or trade from boredom. Profits come from consistent and persistent action, not reaction. Trading against the momentum or trend, never try to pick tops and bottoms. Micromanaging trades. Don't get out unless the trade hits your targets or stop. Let the trade run. Overconfidence. You don't know where the market is going. The market is not always rational. Dealing with losses. Remember, trading is about probabilities. The market doesn't owe you anything. It doesn't even know you exist. Check, are you on a learning curve? Know your daily, weekly, monthly, and yearly loss limits. Every trade is a new trade, and every day is a new day. Learning never ends. After trading, the best gift you can give yourself is being organized. Having a system for trading is great, but it will all be for nothing if you don't have an equally successful organizational system, keeping a log and write down all key points and information. Also, I personally recommend keeping a working journal with you for you to write down things you need to remember in your day, things you learn from mentors, etc. Always carry this journal around and you will never be lost. Read the trades you took and the reasons why you took them. Keep a log, entry and exit points, profit and loss, mistakes made, reasons why you took the trade. Here are some useful general trading guidelines that can help you to stay focused. Trade with the trend. Enter at clearly defined technical levels. Exit losing stocks at your stop. Do not exit winning stocks too quickly. Trade with amounts that you are comfortable with. Avoid trading according to rumors. Avoid trading in news. Avoid trading during the first and last minutes of market hours.